Good evening everyone. Today we have gathered here for study circle meeting on taxation of non-profit organization. It will be taken by Shashank. I would like to hand over the stage to Shashank, who will continue the further session. Have a great learning.
Good evening everyone. Today I am here to talk about the important and practical topic of taxation of non-profit organization. Many people think that trusts do not pay tax, but that's partially true. Exemption is conditional, and the condition should be satisfied to claim the exemption. Now, through this session, we will learn section 2 and subsection 50. That includes relief to the poor, education, yoga, medical relief, preservation of environment, including watersheds, forests, and wildlife, and the preservation of momentums or places of objects of artistic or historical events, and the advancement of any other objective of general public utility. Now the main litigated part is the advancement of any other objectives of general public utility. Now let's understand through an example. There is a yoga center which is registered under charitable trust, which charges the minimum fees to the members that only cover the cost. This will come under the charitable purpose. But there is a yoga center which charges a premium from its members and provides luxury services to its customers. Then it will not fall under the definition of a charitable purpose. Now next will be advancement of any other object of general public utility not to be charitable. If it involves any activity related to trade, commerce or business, but it is treated as charitable purpose if aggregate receipts from business activity is not more than 20% of the total receipt. Now let's continue with the previous example. If the registered charitable trust running in yoga centers provides some fruit juice or protein bars to its members by charging a minimal fees or fees more than a minimal, then it would comes under the commercial activity. If the receipts from that is 20% or less than that, then it shall be considered as a charitable purpose. If it crosses the 20%, then it will be taxable. Let's see some cases here. Advancement of any other objective of general public utility involving or carrying out any activity in the nature of trade, commerce or business, or any activity of rendering any services in relationship to the trade, commerce or business for a fees or any consideration, irrespective of the nature of the use or application or retention of the income from such activity. When we are providing any services for the consideration or in receipt of any fees, we are expecting any consideration, then it shall not be considered as a charitable purpose. The second would be advancement of any objective or general public utility. The same case, I would like to give one more example here. There is a school registered under 12 AB. It also gives service like study hall to others as well as the students of school. Now they are charging monthly fees from the outsiders for studying in the study hall. Now that would be a commercial activity, but if it is less than 20%, then it would be called as a charitable purpose. Now, if in the any financial year the 20% receipts crosses it, then it would be taxable. That would not mean that the registration would be cancelled if the income crosses 20%. If it crosses for more than more few years, then it may lose its registration under 12 AB. Let's see some. In this we can see that we shall submit a form in 10A online for registration of trust, and the department will scrutinize and verification of our documents. If required any additional documents, they can ask for us, and if all the requirements are met, they shall issue a 12AB certificate to us, and then we can commence our activities, and then after that we can claim exemption in section 11 aspects. Next is section 12A, conditions for applicability of section 11 and 12. If we want to claim exemption under section 11 and 12, the following conditions should be met. The first would be trust should be registered under section 12AB, and the second would be the total income is more than basic exemption limit. Then the trust is required to maintain books of accounts and document and get it audited from the audited firm and furnish the report within the time. Let's see the registration process. I have quoted some case scenarios where we will see now. after 1/4/2021, if the trust is already registered under section 12AA, that is before 1/4/21, then it is required to furnish the form of 10A within the 3 months from 1/4/21. Later, as per circular, it was extended till 13/6/24. It will receive the certificate of 12AB within 3 months from in which the application was received. When after receiving the application, within 3 months we will receive the certificate, and the period of registration here would be 5 years without any inquiries. From which date we can claim exemption is that from the previous year when it was registered under 12AA. The next is would be fresh registration. After 1/4/2021, we are applying for a new registration under section 112AB. Then we should apply for the registration 1 month prior to the commencement of the previous year, in which the relevant to assessment year for which registration sought in the form 10A. We shall grant a registration within 1 month from the end of the application. And in this scenario, as we are a fresh registration, we will be provided a provisional 3 years registration without any enquiries, and we shall claim the exemption from the date of registration. The next would be trust granted provisional. Here case will be continued from that provisional registration. Now we are applying for a permanent registration. The time limit for making an application would be 6 months prior to the expiry of approval or 6 months from the commencement of activity. Let's take an example. If we are applying on the 1/4/2024, it would be till 24/25, 25/26 and 26/27. It would end on 31st March 2027, and 6 months prior to it would be 30th September. We have to apply before the 30th September 2026 for the permanent registration, and this time we will get the 5 years registration after all the inquiries made by the authorities. This time we can claim exemption when we have registered prior only. From then only we can claim exemption. The section 12AB procedure for registration. CIT, PCIT on receipt of application shall pass an order for registration for the trust for 5 years. In case of first, which we have already registered in 12AA, then for 5 years the registration would be granted. On receipt of application shall pass an order for provisional registration for a trust for 3 years. In case of new registration after 1/4/24, the registration would be 3 years. That is provisional registration would be given. CIT, PCIT on receipt of application shall call for documents or information and satisfy himself about genuineness of activity of trust and compliances of such requirements of any other law for the time being enforced by the trust or institution as a material for the purpose of achievement of its objective in case of 3 of the above. After the provisional registration, when we will apply for a permanent registration, then we have to, this procedure will be followed, that the department may ask for several documents to produce, and after the inquiry the new registration will be granted. After satisfying, he may pass an order for registration of trust, of refusing the registration or cancelling the registration, cancelled in case of provisional registration within the time limit. For Form 10A should be filed for the in case of registration, and Form 10B in case of renewal. The next would be section 11, subsection 1, income from the charitable or religious trust. Following income of the trust shall be exempt from the tax. The first would be corpus donation. Corpus donation can also be called as a conditional donation, where the donor gives and specifies the objectives where the amount should be utilized. If we can claim the deduction, or we can claim the deduction only when the such corpus donation is deposited in the prescribed mode under section 111 subsection 5, safe investment mode. Let's see safe investment modes of trust. The first would be investment in government savings certificates, units of UTIs, central government or state government securities, debentures of company guaranteed by government. The second would be securities as defined by SGB, deposit with post office, saving bank account, scheduled bank or cooperative society, investment of deposits in any public sector company, investment in immovable property. These are the safe investment. If we want to claim the deduction under for the corpus donation, we should invest in these all these all modes to get the deduction. The second would be standard deduction, that is 15% of the gross income. The third one would be income applied for charitable or religious purpose of India out of remaining 85%. If we apply up to 80% only for the purpose or objective of the charitable trust, then only we can claim the remaining 85% deduction in this explanation work. If 85% of the income could not be applied in the current year, for the reasons that a whole or any part of the income has not received during the year previous, not during received during the year, that is outstanding. It is only possible when SSC follow accrual system of accounting. For any other reasons, maybe for any other reasons, there are certain conditions to be applied for both the cases. SSC has to submit a declaration in Form 9A in case of outstanding and Form 10 in case of any other reasons to AO at least 2 months before the due date of filing the returns. In the second, if such amount is not applied in the year of receipt or the immediate next year, then such amount shall be treated as income. Now let's take an example. Let's assume there is a Balaji trust which receives the donation in the month of March. So as it is the last month of the financial year, it will not be able to utilize full amount issued by them in full 85% in the month of March. So they can file 10 to inform that they will utilize the amount in the next financial year. Let's see an example with you. This is a schedule of accumulation. Let's assume in the 21st year financial year 21-22, we received there is an accumulated amount which is not utilized till the date of March. We can file Form 10A and inform that we will utilize it in the further financial year. The frequently we have to file Form 10, including that we have utilized the amount in the next financial year, specifying that against with the accumulation we have invested or utilized. One more point is that we will claim the expenditure in the year 21-22, not in the year 22-23. While calculating the income of the 22-23, we will deduct these expenditures from the current years of 22-23. As it is already we have claimed expenditure in 21-22, we cannot claim the same expenditures further in the frequent years. Explanation: any amount donated by any other trust registered under section 12A and 12AD. Being a trust, we are donating to another trust. First we shall see this term, where we have donated from a corpus fund. As we have donated from a corpus fund, it is treated as not application. The another case would be we have donated through an ordinary donation, that only up to 85% of the donation is treated as application, and the 15% is not treated as application. These are the normal sections of TBBP that says about expenditure paid in a single day to a single person more than 10,000 in any other more than account paycheck shall be check not treated as application. In this case, we will treat it as non-application. The same would be in the case of TDS. If TDS is not deducted in the previous year or deducted but not paid to the government due to due date of ROI, then expenditure is allowed as application for, not allowed as application for trust. The next would be explanation 4, where amount applied out of a corpus fund shall not be treated as applied in the current year. Let's take an example to understand. A Balaji trust applied rupees 50 lakh in the previous year 23-24 from a religious purpose out of the corpus fund of the trust. In case of 50 lakh is not treated as application for the previous year 23-24. Suppose in the previous year 25-26, trust deposited back the 35 lakhs in the corpus fund out of the income of previous year, then the 35 is treated as application of previous year 25-26. The same comes to amount applied from a loan or borrowing shall not be treated as application in a current year. However, when such a loan or borrowing is repaid from the income of the subsequent previous year, such repayment shall be allowed as application in the previous year. Let's take an example to understand this. So a charitable trust is constructing a building for its charitable purposes. The cost of the project would be 2 crore, and it has borrowed 1 crore rupees from the bank, and 1 crore it has utilized from its own income. The 1 crore which we have utilized from our income shall be treated as the application for the current year, and subsequently when we repay the loan in the subsequent events, then the application would be treated as applied in the subsequent events. To conclude in one line about explanation for amount applied out of a corpus fund or a borrowed fund shall be applied only when it is repaid in case of loan or deposited back in the case of corpus fund. Explanation 5. If any excess application of earlier previous year shall not be allowed to set off in the current previous year, it means excess application shall not be allowed to be carried forward and set off. Let's take an example to understand. Balaji Trust issued a donation of 250 lakhs, and standard deduction as per section 11 section 1 is 15%, that is 37.5 lakhs. Net amount applied to claim the deduction under section 1 is 85, that is 2 crore, but already the firm has applied 220 lakhs. Therefore the surplus is 7.5. The trust cannot carry forward these to set off the application in the further year. So this will lapse in this year only. Section 80G and Form 10B. Section 80G of the Income Tax Act of 1961 allows the individual to claim deduction on donation made to a specified charitable institution and relief funds, typically reducing taxable income by 50% or 100%. The deduction is only available under the old tax regime. Donation exceeding 2,000 must be made via non-cash motion. These I have added these two specify use. This is only available to individuals who have filing their return in the old tax regime. Now, what is the role of a firm? What is the role of trust? We shall understand by Form 10B. Form 10B is an annual statement of donation that must be electronically filed by Section 80G or 35 subsection 1A, approved by the trust NGOs and research institutions to report the donor details. It aims to prevent fraudulent tax deduction claims. It is mandatory with the due date of 31st May following the financial year. Whatever the donations we have received from the individuals, where we give the certificate of HCD deduction, we have to report them in the section in the form 35(1)A. Let's take an example to understand the computation of income. Balaji Trust has a registered under section 1280 as the following information. Gross received from income and expenditure for the year 24-25 2 crore 20 lakhs, and additional capital expenditure is always 20 lakhs. Administration expenditure of the Balaji Trust 28 lakh 89,600, and the revenue expenditure is 30 lakhs 6 lakh 22,400. Let's prepare the compute. Now to compute the income of a trust, we shall first add the income and expenditure account. Here we also take the income of the balance sheet, not only the income and expenditure, but we also add any incomes if they are in the balance sheet, that also we will add. The total income will be 2 crore 40 lakhs, and we shall reduce the expenditures of all the administrative expenditures, revenue expenditure, purchase or investment on fixed asset. As these all will be treated as applied as per sections, we will reduce this, and we will claim a 15% deduction. 15% deduction can be claimed whichever is lower, that is 36 lakh, that is 15% of total revenue, or the remaining amount, whichever is lower, we can claim deduction, as we cannot carry forward any surplus to the further year, so we can claim this much deduction. And if any TDS is deducted, we can claim the refund. And trust can file its return in ITR 07.